Hi everyone, welcome to the Advanced Mortgage Solutions podcast. This is a podcast that assists people on their property journey. Whether you're a first-time buyer or a seasoned investor, we cover all topics. I'm Joel Sadler, and our mortgage expert today is Scott Miller, owner and founder of Advanced Mortgage Solutions. Scott's been a property investor for over 20 years, serving Canterbury-wide, and has an amazing professional background in logistics, management, finance, and obviously real estate investing and mortgage advising. In today's episode, Scott's going to talk about what banks look for when making calculations for home loans. When you're applying to the bank for a home loan, how do you know how much you're going to get? How do you know how much you're going to have to pay back? There's all these calculations that take place in the back end. So Scott, tell us a little bit about how that all works and what people can expect through that journey.
It's a great subject because if you jump online and find some of the calculators, put in exactly the same details or amounts and deposit, and you come up with hundreds of thousands of dollars difference. So, that's certainly not how an application for finance is assessed. Look, we've streamlined that process and now have a digital platform that we can send out to people. They can fill it in on their phones or on their computers or, on their tablets. It doesn't really matter. The last page, there's a big submit button and it emails it directly to me. I can crunch some numbers on actual bank calculators that the assessors at the banks use, so we know what we're putting in is what the eventual application would be seen like, and then we can have either a Zoom call or a Teams call or whatever, or even a meeting at the office, just to go over those numbers. I suppose, especially for first-time buyers, the biggest misconception will be, look, I can afford $500 a week in rent, so I can afford to pay $500 a week in a mortgage. The problem with that is that the way that the banks assess an application are under the guidelines set out in the Responsible Lending Code of 2017. I know this is sounding all official, but I'm going to get to a point, and that is that the first point of that law that came in is, as a lender, you are not allowed to put an applicant into a position of financial hardship, full stop. Right? That's number one. And so several laws before that law came in and it was flaunted and tested to see how much they could get away with. But let's just say some of the banks that may have used the same criteria as they had been certainly very quickly learned that this new law had teeth, and the banks were very much held accountable through fines and the like if they were finding they were putting people accidentally or on purposely unlikely into a position of financial hardship. And where I'm leading to that is that the $500 example doesn't really work, because what you're finding is, here goes how much it would actually cost to repay your mortgage, but the banks are assessing way up here to ensure that there's no chance of putting that particular applicant into a position of financial hardship. So what it means is the assessment process is way harder than what you're actually really going to end up in the real world, but you have to pass the sort of assessment process to get to the real world. And that's where there's that misconception out there on, hey, I can afford it in rent, so I can afford it in mortgage. The actual real world, yes, that is quite possibly the case, but it's not the way that the banks are assessing because of the laws that govern how they can make an assessment.
Right. And does that relate, that sort of buffer above the $500 that they take into account? Does that account for, say, things like interest rate increases?
100%.
Right.
So Look, we know today, October 2025, we're enjoying 1 year rate at the 4.5 mark. In 3 years' time, it is very unlikely that it will be 4.5. We might be in a 5 or a 6 in front of it by then. So the banks have to say, hey, look, we know that rates are really good today, but we've got to assess with half a mind in the future to make sure that we're, again, not putting these applicants into a position of unaffordability through interest rates going up. And so they're doing the responsible thing by making the assessments harder than what they need to be. I suppose the kicker to that is, yes, the protection's in place, but it does make it harder to get a loan.
Yeah. And tell me, so that's the, sort of first home buyer model or buying a house outright. If you're coming to the end of a term, have an existing mortgage, that's obviously really important to talk to you about refixing and all that sort of thing. Does the bank reassess all of the factors like your income? Has your income changed, all that sort of thing? Or is it literally just sort of roll over? Like, what's the process of refixing? a mortgage.
Yeah, so refixing, also called a rollover. So you roll over from one rate to another rate. Look, if you
Yeah.
haven't given the bank a reason to contact you, then it's a simple chance of picking a new rate. There's no reassessment. There's no, anything like that. Look, if you've got behind in your payments or you've missed some payments and the banks are concerned that maybe you're finding things tough, then there might be a reassessment at that stage, just to say, hey, we really are looking to be responsible here. We need to know that your financial health is where it needs to be. So we're going to do that reassessment. So that's a relatively scary little moment. So the idea is, if at all possible, is to not miss mortgage payments or give the banks a reason to give you a call, because then it quickly eases the process of rolling over to something else. After saying, if you are finding things hard, the banks have areas within the bank for hardship and all those sorts of things. And by all means, go and contact them for that kind of relief if it's required. Yeah, 100%.
Yeah. Yeah. Right. Interesting. I think we might do a podcast episode on that, on hardship and just some of the
it's a good one.
things that people can do.
Yeah.
We talked about there's that buffer there when the banks calculate your ability to service a loan. Is there also an element they're trying to avoid risk to themselves as well of people defaulting on mortgages in that whole sort of process?
A bank's a business, right? They want to make sure that they're being paid for the business and products and services that they provide, and delinquencies or slow payments and things like that. They're not things that any business model would go out and objectively try to strive for. So there is some self-serving in there as well, of course, from the business model. But a lot of the changes around how the loan assessment is done is through regulation. It's all there to protect the end user, the mortgage holder.
Yeah.
But like I say, that protection comes with the caveat that it just makes it a little bit harder than it used to be to get finance, and for good reason. If you look at the global financial crisis, for example, that's a perfect reason that things were a little bit too relaxed at that stage. And money was, have you got a pulse, we'll give you some money. I'm exaggerating for effect, of course, but it's not like that anymore. Yeah,
that makes sense. So changing tack a little bit, you mentioned earlier about people moving city or relocating. There's some nuances to that part. Can you give us a bit of an overview?
There really is. So on that responsible, we're coming back to that responsible thing. The lender has to understand ongoing affordability. So if you're moving cities, so, coming from Auckland where house prices are just unachievable and coming down south to Christchurch, which is a big movement of people doing that, the lender needs to understand that they've secured employment in Christchurch. Because if they move to Christchurch, it's a little bit too far usually to transition to Auckland on a daily basis to go to work. There's extra costs involved in that we'd have to declare as part of an application, and then there's the inconvenience side of it as well. So, the lender would very much be asking questions like, okay, show us confirmation through, a transfer of your existing job to the same employer, but in Christchurch, or, a new employment contract with a new employer, but it's Christchurch based. Or if you have a work from home opportunity, get a letter from your employer saying that by moving to Christchurch, this doesn't change the type of job or income that you have been receiving when you do move to Christchurch. And then the banks can simply get back onto the assessment process, knowing that when they've moved here, the ongoing affordability pieces have been ticked off and we're all good to go. So, yeah.
Okay, interesting. And then tell us a little bit of a breakdown around things like, I remember when I worked through the mortgage process thing, questions like, how many kids do you have? How many vehicles do you own? Do you have any credit cards? And that type of thing. Those questions, I imagine they're still all relevant.
Look, I just came across an application that I did in 2006. It was just last week.
Oh, wow.
And the application was 8 pages long. Today, it's 37 pages long to do exactly the same thing. So the need for information and to make sure they're not putting the applicant into a position of financial hardship has certainly increased the amount of information that a lender needs to know. And then also it needs to be backed up with, wage slips or loan statements if you've got a car loan or a phone loan or a loan of any type, a student loan, for example. So the makeup of the family is important. So how many applicants that are working and how many dependents, if you're working full time, did the dependents need childcare? They've thought everything through now. So, is one of the applicants pregnant? Well, we know now how long that's going to take until there's a little bundle of joy joining our world, and that changes the outcome of an application. So we have to, bring more supporting documentation around how we're going to afford things on one wage for a while. So look, it's a really good point to make, and that's, again, you won't find that detail on an online calculator. You won't find that kind of detail in AI or Google. It's just too narrow a field of information for that to be accurate. So again, go to a financial advisor, a specialist in that area, to take you through that process.
Yeah, we found that my wife and I, we purchased a property in Auckland after we got married, and she became pregnant, or she might have been, actually she was pregnant, and we had to disclose that detail.
You've sort of touched on it. One thing I would strongly suggest is declare the truth. Don't omit information because you think it will change the outcome, because non-declaration of facts and figures is something banks very, very much frown upon. And of course, if they find one thing, now they're going to get a magnifying glass out on every part of that application to make sure that there's nothing else that's been omitted. Now, sometimes it's accidental. Oh, I forgot my phone's on. I'm still paying it off. It's on a loan. That's a very common thing to forget, because it's just part of your phone bill, right? You forgot that you haven't paid it completely off. So there's that's the kind of accident that we'll wear that, but you really don't accidentally not know that you're pregnant. Especially later on, and if you turn
and then that income's going to stop soon.
That's right. And you turn up at branch to sign your loan docs, and and it's quite obvious that you're pregnant, and then they look and say, but there's no declaration of pregnancy. Then that has some effects.
Interesting. Yeah. Okay. Was there anything else you can think of that you want to cover off, Scott, in this part around how loans are calculated, and any other tips?
Obviously, there's some simple-ish tips, right? Keep consumer spending or consumer debt to the minimum. And what I mean by that is, don't go out and get massive credit card limits, because banks work off limits, not off balances. Try and stay away, if you can, from afterpays and zips and all of that sort of buy now, pay later kind of thing. When you're coming up to the time that you're really interested in making an application for pre-approval, you might to decrease your KiwiSaver level from 10% to 3%, so it puts a bit more money back into your wallet, and then that can be used as part of the assessment process. So they're more common sense things that, what would I do if people were going to come to me for hundreds of thousands of dollars? Well, that's pretty much what the bank's going to ask you for, to make sure that the picture is what you're telling them. So just a common sense approach to that. If you have got the time and the fore sort of thought of approaching a financial advisor to get pre-approved, knowing that pre-approval will usually last for 6 months, then it gives you that chance to go and do some numbers in behind the scenes before you tell your story to the bank. So if there's any things that we need to work on, we can work on them before we're actually making that application to the bank.
It's interesting. And I just want to circle a little bit around on that KiwiSaver thing. So you mentioned, for example, to increase the cash flow, which the bank will take into account, your income is to reduce your KiwiSaver from, say, 5% to 3% or whatever it might be.
You can do at the moment.
So if you're running at 10, you can drop it back down. So is that something, when someone has a first discussion, like I say, I'm talking with you in your office today or over Zoom about that, and I might go, well, I'm maxed out with my income, and you go, well, we're really close. I could see that your KiwiSave's at 10%. Would you suggest those little options to people to kind of?
Meetings today already, and every one of them was around, hey, you're tight, but decreasing the percentage that you go and put towards your KiwiSaver brings us back some breathing space. Look, it's the years and years and years that you've had your KiwiSaver trundling away in the background to build that first home buyer deposit, by putting it down to 3%, a couple of months or even 6 months, if it takes you 6 months to find a house and eventually buy it, it's not going to make a massive difference to how much you've saved through the KiwiSaver by reducing it to 3% for several months. You've done the hard yards already in most instances. So reducing the KiwiSaver contribution just before you're looking to buy a house is a very, very common thing to do.
100%. It's a bit of gold there. Yeah. Awesome. All right, Scott, thanks for today. Really appreciate the insights. And we'll see you on the next episode.
Very much. Bye.